Think you have to have a perfect credit score to buy a home? Well, think again. Let's bust that myth plus 4 more that could be preventing you from owning your dream home. If you are new here, my name is Chris Spade at Keller Williams Realty, and I make all these videos to help you make sense of the real estate market. If you do me a huge favor, please click that subscribe button. Also, click that little bell so you can be notified every single time I drop fresh new content. And if you found value in this video, chances are someone else did too. So please share it with them. So let's get to the myths. There are 5 of them, like I said, and we're going to break them down one by one so you understand why you don't have to have that perfect credit score. So that is myth number 1, that you actually have to have a perfect credit score. Now, perfect credit is 850. You do not need to have that to buy a home. So there are different loan programs that you fall into. For example, VA, if you're a veteran or active duty, you don't need to have an 850 to get that 100% finance loan. You can go as low as 580. There's other things that we're going to talk about that will contribute to whether or not you can get that loan, but having that perfect credit score is not necessary. An FHA loan, you need to have your credit score in the 6s. Now, if you want a very awesome loan and you're doing conventional and putting 20% down, the more you put down, the better your credit score is, the lower your interest rate is going to be. So everything is factored in, but you do not have to have that perfect credit score. That is myth number 1. So just get that out of your head. You do not need to have that. Here is myth number 2. Checking your score actually hurts your score. Now, there are 2 different types of credit pulls that you need to be aware of. The first one is called a hard credit pull, and the second one is a soft credit pull. So a hard credit pull is when you are applying for things like credit cards, mortgages, cars. Lenders are going to go in and they're going to do what's called a hard credit pull. They're going to look at your overall credit. Then there is a thing called a soft credit pull. Now, this happens if you check your credit score, or if, for example, as part of a pre-employment contract, your employer is going to look at your credit. Now, let's talk about a hard credit pull for just a second, because those are the ones that truly matter. Now, let's say you're shopping around for the lowest interest rate credit card and you are applying for different credit cards. You may not want to do that because each and every time that you get your credit pulled on a hard credit pull, it goes against your credit and ticks it down just a little more. The exception is when you are looking for a mortgage. That is the exception because the credit bureaus know that you're trying to get the best interest rate on the biggest purchase that you're ever going to make. But hard credit pulls for things like credit cards or hard credit pull for getting a car loan, those are things that you're going to want to be very careful when doing. Like I said, soft credit pull is completely different. If you're going in to check your own credit, that's okay. But just make sure you keep in mind of hard credit pulls because that is going to bring your credit score down. Now, let's give you a few tips to monitor your credit score without your credit score actually going down. The first thing you want to do is use free credit tools. So for example, with my Capital One credit card, I have a credit check already built into my Capital One credit card. Keep an eye on that. It's not a perfect score, but it gives you an idea because anytime an inquiry is made, you're going to get a notification. The second thing you want to do is you want to check your credit report annually. This is important, and the credit bureaus do have to give you free credit reports annually, so double check your credit report. If there's anything on there that is not right, then make sure you report it to the credit bureau. And the third thing you want to do, you want to set up alerts for your account. So for example, on my bank accounts, every time a purchase is made, I get a push notification on my phone. Same thing with my credit cards. Every time a payment is made or every time I make a purchase, a push notification comes through. Now, I got notified on my card that I had ordered something online that I hadn't actually ordered, so I knew my card was compromised, and I happened to be scrolling through social media when it happened. So I was able to catch it right away. I notified my credit card company immediately, and the whole thing was squashed just like that. And myth number 3 is that you have to have a long credit history to even apply for a mortgage, and that's just not the case. One of the things lenders look at is what's called DTI, or debt to income ratio. So let's explain a little bit about what that is. So your DTI is the percentage of your monthly income that goes towards paying your debts. So what your lender is going to do, they're going to look at your total monthly payments, divide it by your income, and come up with what is called a debt to income ratio. Now, a good rule of thumb is to keep that below 36%. If you can keep your debt to income below 36%, you're doing very, very good. The other thing that they're going to look at is your payment history. Now, if you record a good payment history, that is only going to give your credit score a boost. But things like late payments, payments in collections, or missing payments, those are all going to go against your credit score. So having a very good payment history is going to help you when it comes to boosting your credit score and getting a home. Myth number 4, paying off your debt will immediately increase your credit score, and that just never happens. So let's explain why. So let's talk about a little thing the credit bureaus like to use in order to determine your credit score that lenders look at, and that is called credit utilization. Now, credit utilization is the ratio of your credit card balance to your credit card limits. What does that mean? So credit utilization is a major factor when credit bureaus and lenders are looking at your viability to get a mortgage. So when you pay off all your debt, your credit utilization score goes down. Now that is going to be a temporary hit on your credit because it takes them time to report this. The credit card companies take time to report this to the credit bureaus, which then will lift your score back up. So if you go and pay off a credit card today, it might take 60 to 90 days for that score to go back up. And that's okay. Just remember, it's not an overnight process, but your score will eventually take a bump. So just remember, positive behavior takes time to reflect in your credit score, so you just have to be patient. Myth number 5, and that is closing old credit card accounts actually boosts your credit score, and that is the worst thing that you could do. Here's a fun fact. Credit history makes up about 15% of your overall credit score. So when you close your oldest credit card account, you've taken away 15% of your credit score, which is going to cause it to drop. So you don't want to do that. But here are some things that you can do to make sure that your credit score stays high so you can buy a home. Now, let me just give you an example. Let's say you have 2 credit cards and you have $10,000 available credit on each one, but you close one of those accounts, which then lowers down your available credit down to $5,000. So you've just taken your credit utilization from 25% to 50%, which then is going to lower your credit score. The better thing to do is pay off those credit cards, and if the lender decides to close the account, let the lender do that. However, the better option for you is keeping smaller